Welcome back to 22 Minutes in Lending. I'm your host, Vince Passione, and today I'm joined by someone I've had the pleasure of working with for over a decade, Mick Olson, President and CEO of TopLine Financial Credit Union. Mick has been with TopLine for over 20 years, serving as SVP of Finance, CFO, and now President and CEO, where he oversees a credit union with more than 70,000 members. With a background that blends finance, technology, and strategy, he's led TopLine through growth and change while keeping an eye on what's next for his members and for the system. Mick, welcome to the show.
Yeah, thank you. Good to be here. Thanks for inviting me.
Awesome. So, Mick, credit union's about 93 years old from what I can tell, or is it 90 years? 90 years.
Yep, 90.
Yeah. So tell us the background. Tell us how the credit union started. Tell us a little bit about, where you're at these days as far as membership. And I know you just rebranded your not rebranded, you came up with this new mission statement, right? Connected, we all do better, I think is what it says. I was looking at your annual report. So tell us a little about the credit union.
So we were founded in 1935 by 7 employees of AT&T. They gathered their funds, and they also had $35 that they started with. From them, we grew along with AT&T, and with the breakup, in the 80s, we really looked to go to more of a community-based credit union. So, we had been a state charter. We moved from a state charter to a federal charter in the 90s. Since then, we've gone back to a state charter, and there's a lot of reasons why credit unions do that. Ours in Minnesota is just trying to get the territory that we wanted to fit into our charter was more advantageous to go with the state charter than a federal charter. So we made that decision. We've had a couple of mergers on the way. We did a lot of mergers before I came here in the 90s with some smaller credit unions. Then in 2011, we merged with about a $45 million credit union in the South Metro of the Minneapolis-St. Paul metro area, and that really helped diversify, into a really different member base, and that's really helped. And then in 2024, we did a merger with another $330 million credit union, Anoka Hennepin, and so we expanded our branch footprint and expanded our member base. So that's really how we got to the 70,000 members now, and now we exceed our assets about 1.1 billion. So we've seen a lot of growth. Certainly the last 20 years that I've been here, we've been growing tremendously. So it's been good. We have very loyal member base, and we feel like we serve them well, and it's given us some great success.
So, Mick, congratulations on the growth. What does membership look like for you? What's the average age? And when you're acquiring these members as a state chartered credit union, right? I mean, membership for them is they live, work, or worship in the state. So you're wide open that way, or do you use open fields? But let's start with demographic. What do they look like from an age perspective?
We've gotten younger. When I started, we were creeping up towards the average age of about 50, low 50s, which was on an average is quite high. We've moved more towards the lower 40s, 42, 43. And so we've been able to do that. Some of that was with the mergers. Some of that has been, our initiatives to really grow our younger member base. And I know you hear that from credit unions around the country. Everybody wants to attract the younger borrowers with the challenges of the fintechs, but we've been fairly successful in doing that with our outreach and our marketing. Certainly student lending is a part of that. Trying to focus our credit cards on doing more approvals for thin files, et cetera, has really helped grow our membership.
Now you have 11 branches, and we hear this all the time, right? Do you need a branch? Do you not? Do younger members go into the branch? Certainly during COVID, right? Even baby boomers, right, needed to suddenly become digital, right? And there's an old saying, right? There's no digital deniers anymore since COVID, right? Everybody learned to get digital. But when you look at branch usage, what does that look like for you? And is it a billboard for you? Is it an education center for you?
It depends on which branch you're referring to or looking at. We have a couple of branches that do a lot of shared branching. So they're not necessarily our members, but they're quite busy. And they serve really a large demographic around that area in our metro. We have some of the acquisitions we've done, the mergers, we have a lot of very low balance, high activity members that um, some come from different immigrant populations where they focus a lot on cash and they do a lot on a family structure, commingling funds and things, and so they do a lot of transactions. Some of our other branches, really, especially one de novo branch that we just opened. The traffic hasn't really been there, but they're certainly getting a lot of phone calls and a lot of digital applications that they're processing and coming through. But we just did a merger and just a conversion last month, and the lines at the branches were really out the door. And it wasn't necessarily that people had issues; they were just looking for someone to talk to maybe help online banking questions. And it's remarkable how many actually drove into the branch to have those conversations. We did have quite an extensive increase in phone volume in our call center, but we also had a lot of members who really value having that physical presence and came in just to have a conversation. So that reinforced for us in where we're at in Minnesota, the need and the desire for members to have that consultative relationship with their credit union. And so we still think, even though we may not have the branch transaction volume that we had, say, in the 90s, but it's still very valuable to our members. And they may not come in very often, but when they do, they really want that branch presence. So, and if they are billboards too, don't get me wrong, we're making sure we're in the right locations and that members are seeing us and that they can really appreciate that we're there and have our brand awareness and everything. So, but in fact, the actual usage of the branch has continued at a higher rate than what I thought it would be.
Okay. Let's talk a little about, because there's about lending. So let's talk about your loan book. So I was taking a look earlier at the 5300 report. Looks like about $250 million in auto loans, a little over $400 million in residential, and about $100 million in commercial. And I think there's close to 20 in credit cards.
Mhm.
So I think I got it right. Are there areas that you're looking to grow in? How do you see this for your membership, and how do you see it for TopLine?
Well, we've really tried to diversify, and I think we've got a pretty well structured balance sheet right now. We were at 108% loan to share before this latest merger, so we're really looking very closely at our concentration risk policy and making sure that we were kind of growing all portfolios at the same. Now we have increased our unsecured, like our student loan portfolio. For a long time it was 1 or 2 million. We've really increased that up to upwards of 9 million now in our partnership with Member Student Lending and LendKey, which has been very valuable to us. Been a very well performing portfolio. Love the structure, that whole the way that we have the participations and the structure of the entire portfolio and the offering. So we think that overall we're well balanced.
Mhm.
We are trying to get a little bit more on the younger side, the loans they need, focus a little bit more on direct auto lending, focused a little bit more on credit cards, but we're certainly, we have another QSO relationship with, or a couple that we do commercial loans with. We're certainly focused on expanding that capability and serving our members in that way. Unsecured loans, if you can do it in the right way, it's a great add to the portfolio. So looking at our concentration risk, we're we're well structured right now. We're trying to grow everything pretty much in proportion, but there are little subsets like unsecured that we're trying to increase to really enhance our overall yield.
So let's go to education lending. So you've increased the education lending side, about $9 million balances on it. You've been involved for 10 years. You were the chair of the board of member student lending. You're a member of the board of directors. We look in the credit union reports, and there's about 700 credit unions, I think, in the country that write education finance loans. And
Hmm.
you've heard me many times have this conversation about, why can't we get more credit unions to do this? Everybody wants to get young. Certainly, I have a lot to say, but I want our listeners to hear your decision to do it, your experience to date, and then why should they do this, right? Because there's so much going on right now, especially now with the big, beautiful bill and the impact it's going to have on members, right? But let's start off with why'd you do it and what's your experience been as far as profitable? It's a lead-in product, the upsell, cross-sell.
Well, we were hesitant at first. It wasn't until we found the model that member student lending and LendKey had, where we were sharing 10% of the risk, that really got us to move. Because at that time, when we first started, I was the CFO, and our CEO at the time was very reluctant to do a lot of unsecured credit. So once we identified, the benefits of the program, the structure of it, that really, got some traction. We were able to show the projections at first, and those have really proven out. I mean, you know, we haven't seen any of the losses that you hear about. And I think that's part of when you ask the question why people don't do it. They're all looking at the needs-based lending from the government perspective. They're not really understanding how the student loans are underwritten, how the risk is shared within the model that we're offering. And so I think it's a lot of education. It's a lot of credit unions need to move a little bit faster. As an industry, we're slow to adopt in a lot of ways, and I think we all recognize that. We just need to really, look at the way it's structured and see why it's different and understand and get educated, and then look at the results and be able to see, okay, what's it been over the last 10, 15 years, and how is it, this structure is really proven. So I think, why people aren't adopting more, I really do think it's education, and it's just a risk tolerance that as an industry we just really don't have. Certain pockets do, obviously, but um, as a whole, I think it's those two things. It's education and it's risk tolerance, and really getting people to understand the opportunity.
Yeah, and look, thank you, right? Because we started to collaborate over 10 years ago when we started building what we now call network lending, which is the ability for someone like TopLine to originate a loan to a member and then in real time participate out 90% of it. And that risk mitigation strategy and the work that member student lending has done has really helped us grow that business. Mick, when you think about the future and you think about what's happening with this big, beautiful bill, there's lots of issues here, right? You've got these grad plus loans, which today any student can go and get full cost of attendance. So if you want to be a lawyer, a doctor, a veterinarian, a nurse, you can borrow full cost of attendance from the United States government. And then when you graduate, you basically apply for income-based repayment for 5 years while you're doing your residency, or if you're an associate in a law firm. And then eventually you become a partner and all is good.
Mhm.
But that's going to go away. And on the Parent Plus side, and these parents, their demographics are exactly aligned with credit union demographics. It's anywhere between 45 to over 53 years old. Income looks like it's about $100,000 a year. They're borrowing for their children. Those used to be full cost of attendance. Those now those are going to be capped, and there's going to be an income-based restriction as well. So, the analysis that we've done and we've shared with member student lending is the need for education loans, private education loans will probably double as we go into 2026. What do you think as far as changes to the program or what your concerns for your members? How would you change the program, or what would you advise other credit unions to be doing right now?
Well, I think we have to understand the need and how a credit union has to understand and define how they want to help their members. And if they want to help these younger members, and they can do it in an affordable, structured way, certainly the guardrails are there with the underwriting. They're not need-based loans, they're underwritten loans. So I think we have to decide how much do we want, what's the need going to be from our members, and how can we help them, and how can we increase our commitment to helping them with these student loans, recognizing, a lot of the programs that are more heavily impacted by the bill are going to be the most educated, the most solid earning jobs in the country. And so you're not we don't discriminate, obviously, but when we look at the opportunity and where the demand is going to come from, it's coming from, your best potential earners in your member base, and that should really drive a lot of the decisioning and why people would want to increase and move in there, but increase their exposure to the portfolio. But a lot of it is education and understanding and you know, setting that goal of how can we help our younger members that really need the help, and how can we be there for them? That's why we exist.
No, well put. So as you look ahead, how are you going to differentiate yourself? We've had other credit unions on, and certainly we've had other fintechs on, and consultants, and people talk about, well, find a niche. Is it a niche strategy, Mick, for top line? How do you differentiate top line going forward?
And that's always the challenge. People always say, what's every consultant we work with, no matter what it is, seems to ask, what's your target market? Well, we do have a target market, but we're also recognizing that we need all walks of life in order to really to fund the loans. We need savers, we need borrowers. Everybody in town, and in the country is talking about service and how coming into our branch is different than the others. And there are differences certainly within credit unions, within banks. Um, but I think the entire industry is really focused on, service and making sure that we're providing the best service that we can for our members and for the community. And so we tout that quite a bit. We think that's a differentiator for us. But the other side of it is what products we're offering. Not everyone has a mortgage area. Not everyone has insurance or investment advisory. Not everyone offers student loans. And those are the types of things that, although a lot of credit unions do pieces of what we're doing, we think we've got a really well-balanced product offering that, combined with the culture that we built and with the brand identity that we've really focused on. I think all of those combined really help identify us and make us more unique. But still, in the end, we're all offering some of the same services. It's the combination of those items that I mentioned that really we feel differentiates us.
No, and look, it's funny, any neobank you talk to will say the same thing, right? You have to have a full suite of services. You don't want that client walking away and finding a product that they can't have at your financial institution. So that's solid. So, Mick, let's talk about the future of the industry. So you've been in the industry a long time. Lots of concerns about tax exemption. So do you think that goes away? Do you think it stays? Does it matter? Are people making a bigger deal of this than it needs to be?
I don't think it goes away. I don't think it's the threat surely has lessened from my perspective over the last 6 months. But I think it's always going to be there. I think it's something that we need to figure out if it ever does happen, how are we going to react? How are we going to respond? Um, so I wouldn't say it's a tier one threat, but I would say it's always something that we certainly need to pay attention to. We
Mhm.
certainly need to justify why we are tax exempt and what services we provide. And if we're doing things the right way, I think it'll stay there.
Okay. What happens with the NCUA or the CPB? I mean, do you wind up having a prudential regulator be the FDIC? Do you care?
I do like the fact that we have our own regulator. I think we're unique in that way. I think if we all get thrown into the same pool, we're going to have, because we are structured differently. I don't think the regulations need to be identical to a bank or a credit union. I think there's enough differences there that having a separate regulator. Now we're state chartered, so we're really focused on the Minnesota Department of Commerce, but understanding that even though we're state chartered, we're still regulated by the NCUA. So I don't think we should have the same regulator. I think, like I said, we're unique enough. As far as the CFPB, I'm glad that some of the regulations have backed off, especially some of the things they were proposing that we do. There are certainly consumer protections that need to be there. Um, I just don't think the CFPB remains the way it is long term, but we'll have to see.
Yeah, that's right. So final question. So over the next 5 years, if you had one problem to solve for your membership, what would it be?
Well, we've been focused really on the financially coping, and so we're going to keep focused on that. We're going to keep focused on financial education, trying to get our members. We think we've got a good product mix, as I've mentioned, but really that counseling, the in-person, and that's why we're continuing to expand our branches because we see a lot of value in that. And so I think the solving some of the budgeting and planning issues for our members and who are financially coping, solving that, I think is the first thing that we can do. And then we can move on and do expand their ability to make the achievements in their life and lead the lifestyle that they want. But I think it's a serious problem that impacts members of all economic standing, not just those that are struggling. We've got members who are making a lot of money that are still financially coping because they just need more education.
It's 80%, right? Folks in the United States live paycheck to paycheck. So absolutely right. Mick, congrats on the success. Thanks so much for spending time with us today. That wraps up our episode 22 Minutes in Lending. Again, Mick, thanks so much for joining us. And to our listeners, thanks for tuning in. And be sure to subscribe, share, or join us for our next episode. Mick, thank you.
Yeah, thank you. I appreciate it. Thanks for having me.
Thank you for listening to the 22 Minutes in Lending podcast. We hope you enjoyed today's episode. You'll find links to any resources mentioned in the show notes. If you're enjoying our show, be sure to subscribe and leave us a 5-star review.